is one of the fastest growing startups in India, but is not doing well on operating profits. Right? The EBITDA is still negative.
Yeah.
So how is it one of the best companies?
Yeah. No, I mean, ask Forbes. Not me.
One is your Valmo and the whole logistics bit. Second is, who they are targeting. They've really nailed it down in terms of what they're selling and who they're selling to. And last and most importantly, the zero commission bit, which I still don't think is sustainable.
So over time, that should change, is what you're saying.
I feel it will have to.
Handling charge.
Yeah, I mean, you mask it however, you all those dark patterns are a thing now. This episode of Taking Stock is brought to you by Paterson. Okay, hello and welcome to yet another episode of Taking Stock. This is a weekly podcast where every week we pick one company, one stock and dive into it. And this week we're talking about another e-commerce company. We spoke about a few e-commerce brands. And this is a company that is started by two folks just down the road in Koramangala. Right? So the company we're talking about, I'm sure you already know, is Meesho. Now, the first thing that I want to ask you, right? I just came across this article when I was reading about Meesho, where it's an article in the Forbes magazine, which says Meesho was voted, tagged, not sure, as the best IPO of the year. Right? Now, I have two questions. What does best IPO of the year mean? And why was Meesho the best IPO of the year?
That we'll have to ask Forbes, but my simple assessment would be that one, the IPO was oversubscribed by almost 79 times.
So, I mean, is that the highest or one of the highest, I'm assuming?
On the higher side.
Right.
And the average listing gain in 2025 was about 10%.
Okay.
But the listing gain for Meesho was much higher, which was about 40%, 45,
Understood.
46%.
Right.
So that was the second factor. And the third factor being that they got a valuation of about 1 lakh crore, which places them in that league of mega listed companies.
Understood.
So I think those three angles as a combination, plus the founders becoming billionaires because of the listing,
Right.
would have together culminated into
this PR storm.
Yeah.
Okay. So anyway, I mean, I think everybody knows what Meesho is too big a company or too big an organization to miss now, right? And I think everybody knows what Meesho does. It's basically small towns ka Flipkart and Amazon, right? To sum it up. And I mean, this sort of reminded me, right, that we recently did an episode on Vishal Megamart a few weeks ago. And isn't this exactly what Vishal Megamart does, but an online version?
Yeah, so I think the target market is pretty similar.
Right.
In terms of geography as well as in terms of persona.
Correct.
So they're targeting the same guys. So I would say what Vishal Megamart is in the physical retail space is Meesho. And what a DMart and others are what Flipkart and Amazon
Understood.
So that's the analogy I'd probably draw.
So Meesho essentially it seems quite surprising, right? Because when you look at e-commerce as a system or as a mechanism, the whole concept of e-commerce goes beyond physical boundaries, right? So you would assume that if Flipkart or Amazon or whatever, there's a whole list of these companies that have killed it in the e-commerce game. Why would they ignore the smaller towns, the tier 2, tier 3 towns?
No one's ignoring the towns. It's about what your marketplace attracts as a crowd because of what you're selling there.
Correct.
So let me put it another way. Vishal Megamart, if I sort of go back to, right? We were at a place where the DMarts of the world, for example, the average selling price of whatever they were selling was probably 2-3x of, or the revenue per square foot. That's a good metric, right? 780 rupees was, if I remember correctly, for Vishal Megamart.
Right.
For DMart, it would be close to 3,000 bucks.
Correct.
Now, similar is the situation with these guys, where the average sale is about 270 rupees.
Fair enough.
And the others would be at least 2 to 3 times higher.
Much higher. Absolutely.
Other differences, so it's not a geography, they're not choosing or ignoring a certain geography. It is about
they're listing products that come within that price band, which then attracts a particular set of people as their buyers.
Yeah. So in effect, what has happened is that these are people who are more price sensitive, they are aspirational, they have access to consumption patterns at an urban level, and they want similar consumption or consumer goods, but at lower prices. So they're not necessarily brand conscious.
Correct.
They want the use of the product, but price is the primary determinant of what they're buying and
Correct.
selling.
Because what we're also, and it's not really an assumption but a fact here, that when you go to smaller towns and tier 2 towns and tier 2 tier 3 towns and cities, people's income levels are much lesser compared to a Bangalore, Bombay, Delhi, Chennai, etc. Right? So because income levels are lower, price sensitivity increases, and that's where the focus on brands is not important. Right? It purely comes down to disposable income at the end of the day.
Yeah. So it's all determined by price. So if you also look at, like, for example, Meesho versus the others, the interface itself and the platform, forget the interface, but if you go onto the app or whatever, you'll see a lot of the description or the name itself of the object will be, or the good will be, black printed sneakers for men, for example.
Understood.
Round neck t-shirt or whatever, right?
The description more than the brand.
The brand is never mentioned. So it's not about the brand really. See, 95% of the sales that happen or the products that are sold on Meesho today are not branded.
Okay.
So these are usually resold by people. They're either locally made, or they are cheap imports, or they are just knockouts of existing brands, just copies, for example, or whatever. And these are the goods that are actually sold on Meesho.
Understood.
So it's not about going back to your question of why has Flipkart not done that, because they've got brands. Meesho's model is not that.
Understood.
And hence it's attracting that crowd.
Makes sense. So I understand exactly what you're getting at right now. So I mean, what we are establishing over here is that what they are selling is non-branded, generic. It could. I know I'm sort of focusing on clothing here, but it could be anything, right? Accessories, clothing, literally anything. But so more than what they're selling, what it sort of comes down to as a differentiator is who they are selling to.
See, so what they're selling will also over time get molded by who they're selling to.
Okay.
So I'll give you an example in this case. Flipkart, Amazon, for example, electronics form a majority of their merchandise value.
Correct. Right?
For Meesho, 35% is fashion and apparel, 15% is footwear and accessories.
Right.
About 10% would be baby and kids stuff. About 18% is home and kitchen. 10% personal and beauty care. So they've the composition
covered pretty much everything.
Yeah, but then look at it this way: that composition for these guys is materially different from an Amazon or a Flipkart.
Correct.
So the point I'm trying to make is they will be present everywhere, and they will be market leaders when it comes to volumes in certain categories like fashion, for example, or in home and kitchen. But again, there's a difference in terms of what they're selling.
Correct.
So you won't find, for example, I actually for research just logged onto it and saw the shoes there. Like usually if I shop at like an H&M or Zara, the price range is completely different.
Correct.
And here you're getting shoes for like starting at $250.
Right.
So it's very different, the kind of stuff you're getting here.
Yeah, of course. Even when it comes to, I'm assuming, like electronics and stuff, you will get cheaper brands compared to, you know, nobody's buying a TV for 2 lakh rupees on a Meesho.
No, so all the whatever you see on Meesho, even for example, I saw a few headphones on Meesho.
Right.
Those are brands that I've probably never heard of before.
Right.
There's very few brands that I've come across before and that are on Meesho.
Correct.
And one of those things why this is also happening is because brands are not really present on Meesho.
Right.
It is usually resellers. And that has to do with the model differentiator itself. So when Meesho started, for example, they realized that they have a lot of buyers, but they have an equal number of people who want to sell as well.
Correct.
And these were your typical homemakers and people without substantial
small stores
employment.
Also could be, right?
Could be. Or people just sitting at home and want to make a business.
Right.
And that's how they dwelled into this angle in the first place. So one of the things that they do is actively they're built for small companies or small individuals and not really for brands. That's the fundamental difference in terms of, while we've spoken about demand side of things, the supply is also similar.
Correct. This episode of Taking Stock is brought to you by Paterson. So, I mean, this is what's fascinating, right? That even though we say that, you know, the average order value is 200 and I think 270 or something you said, right? And they're targeting a very different kind of audience compared to an Amazon, Flipkart. But the fact of the matter is that majority of India falls into this audience.
Yeah, I mean, we get
When you look at
surprised
volumes,
yeah.
right?
No, for sure. And that's what happens, right? Even like when we were talking about Vishal Mega Mart, for example, you said that I've seen so many DMarts around, but I've not seen a Vishal Mega Mart. Whereas the number of Vishal Mega Mart stores in India are much more than DMart.
Correct.
Similar was with Meesho when, I mean, you obviously being in finance and business, I'd heard about Meesho quite a bit. However, I think today was the first time not today, but whatever, was the first time I've gone onto the site or downloaded the app.
Yeah, and to be very honest, I haven't, and that's the thing, right? As urban folks, we think that we are we think we are very what do you say, tech savvy in terms of buying things online and etc. But what we forget is that everybody across India is now buying things online, right?
Yeah.
The adoption of buying something online has only increased, and now thanks to Jio, where every corner of the country has free internet, everybody wants to buy stuff online.
Yeah, so there was like a couple of stats in the Meesho DRHP which were very interesting. One is that currently tier 2, 3 and beyond form about 44% of the entire e-commerce market in India.
Right.
And this is expected to move to 50% by FY30. So clearly that market is growing much faster compared to your urban markets. And the second fact was that internet penetration e-commerce penetration in tier 2, tier 3 and beyond is at 4%, whereas it is at 14% for metros.
Right.
So those two drivers sort of accelerate growth quite a bit for Meesho when it comes to just being present in that market. So yeah, and this was a statistic similarly in the whole retail space as well, where retail spend, for example, in tier 1 is at about 30 lakh crore. But tier 2, tier 3 and beyond would be beyond 50 lakh crore.
Correct.
The market is much larger, but because we're exposed to a whole different set of platforms or a whole different set of businesses that we interact with, we don't usually end up coming across what's used by the masses.
Correct. So let's look at what I mean. Meesho's obviously done extremely well for themselves. Apart from just having a blockbuster IPO, as a company, they've just grown at an extremely fast pace, right? So what is it that, one is they've really nailed down their, what they are selling and who they are selling to has been very clearly well established, right? But what are the other differentiators that sort of stops maybe somebody else building the same platform?
So one of the most radical things that Meesho did, for example, was that the norm for any e-commerce platform was that you charge 15 to 20% commission to whoever is selling it.
Correct.
Because you're enabling their sale on your platform.
Right.
And that's the fee for making the market for somebody. However, what happens is that this is affordable for brands. This is affordable for goods that are higher priced.
Because they have that much margin available.
Yeah. However, when you're talking about stuff where people are actually smaller in nature in terms of their size, and the average order value itself is smaller as well, then that becomes a little unviable. So what these guys did was that, and initially they were also charging a 15-20% sort of platform fee or whatever commission to sellers. But this was locking out about 3/4 of the sellers who are too fragmented and who have margins which are too less to give to a marketplace.
Because essentially, if you're selling shoes for 250 rupees, you cannot really possibly afford to give a 20% commission to Meesho.
Yeah. So and that's when they realized that a lot of their sellers are also like these smaller ones and whatever. Right? So in 2021, somewhere towards the end of the year, these guys said that, hey, we're going to not charge any margins or commissions. It's going to be 0%.
Right.
And I think that was the game changer in terms of increasing the network or the product space itself or the product breadth that you have on the platform.
So how do they make money then if it's 0 commission?
So they charge for fulfillment. So basically, if you're the seller, I will not charge you anything as Meesho. I'll not charge you anything for listing your product, and when a sale happens, I won't charge a commission on it. However, that product has to be delivered as well. So I will charge you a delivery or a fulfillment fee.
So if I'm a seller, I am delivering that product to whoever person X who's bought it on Meesho.
Meesho is fulfilling it.
So Meesho makes sure that the product is delivered. Okay.
Delivery is Meesho's job. Right. But for that job to be done, there'll be a fulfillment charge that will be charged. That is one revenue source. However, a majority of the revenue, this is a smaller one, majority, because this also has a cost associated with it.
Correct.
Majority of the revenue comes from advertising. So
Okay.
basically, as any marketplace, if you
Right.
want preferential listing,
Correct,
you
correct.
want ad space, you want whatever, so all of that becomes a revenue source for Meesho.
Right.
So typically what we've seen in e-commerce is that out of the total gross, whatever the gross merchandise value is, 4% of it seems to be like a ceiling when it comes to how much retailers or sellers are willing to spend on a platform
Right.
for advertising.
Understood.
They don't spend beyond 4 to 5%.
Okay.
So that itself becomes the revenue for
Right,
Meesho.
for Meesho.
Because beyond that, what happens is sometimes the return you're making on that investment on marketing or advertising is something you'll not healthily make up for.
Correct.
You won't get a ROI basically on that.
Understood. But I'm just trying to understand that Meesho, and you'll probably have the exact numbers, right? That Meesho's turnover is hundreds of crores, maybe 1,000 crores, right? So you're saying majority of that revenue is coming only from this 4%, 5% advertising costs.
Yeah.
Okay, okay. Fair enough. That seems quite off, no?
Why?
I don't know. I mean, it's a huge number coming from just advertising.
Imagine this, right? At the end of it, the volume we are talking about at this point in time, for example, Meesho is doing about, and numbers vary, but they're set to do about 30% of the total shipments in e-commerce in India.
Wow.
And that is the largest.
Right.
So it is the highest in terms of share.
Correct.
It may not be the highest in terms of revenue share, because the AOVs are 1/3 of what the others are commanding.
Correct.
But in terms of sheer volume, it is humongous. And I'll tell you about one of these things that had happened there, right? Like, for example, there was Ecom Express, which we spoke about in delivery.
Right.
I think we've covered enough companies
to go back,
to keep going
Go
back.
watch all the episodes right now after this.
Ecom Express was acquired by Delivery. At one point, more than 50% of revenue for Ecom Express was coming from Meesho. Ecom Express's job was to just deliver.
Right.
And what happened is Flipkart and Amazon moved towards their own captive delivery. Meesho didn't have their own captive delivery at that time, and they changed the business model a little bit, right? We'll come to that a little later, maybe in the next part. But as soon as they changed it, Ecom Express went into trouble.
Right, because they were so dependent on Meesho's orders.
And that was the case with Delivery as well.
Right.
But Delivery also, if you go back again, they've got PTL, they've got FTL as a business.
Correct.
Sorry, partial truckloads and full truckloads.
Right.
So they're not only doing e-commerce, they've also got other businesses which shielded them from Meesho's business plan change.
Understood.
Or business model change.
This episode of Taking Stock is brought to you by Paterson. This whole zero commission initiative, whenever Meesho did that, right? I'm assuming it was done from the point of view of becoming very seller friendly as well.
Yeah.
Right? That it's not just that, okay, you've got X number of buyers who are coming onto your platform and buying things, but what's the point of having 100 buyers if there's nobody selling good stuff? Right? So I'm assuming that was the mindset behind doing this, right?
See, a lot of these models work in a way that the larger your network is, the more successful you become. I'll break it down. So for marketplaces, for example, if you have a limited set of products, nobody's coming there.
Correct.
So you need to have a wide spread of things available for people to come there.
Correct.
It's like dating apps are a great example of it, because if there is only a small pool of people, then that app won't do well. The larger the pool, the more the usage.
Correct.
So even here in this case, either you get brands which have a wide array of products available, or you get a large number of resellers which may have a smaller catalog, but you provide the breadth throughout.
Right. So you see this, I mean, when we talk about marketplace, I'm going to drift away a little bit from Meesho, but when you see brands like a Swiggy and Zomato today, right? And it's a classic example of how they are an aggregator, right? And you see now a lot of restaurants, not just in Bangalore, but across the country, complaining about the fact that they charge a 25, 27, 30% margin. Right. And we've experienced this where you see so many restaurants today who don't want to list on Swiggy, who would be happy selling through their own social media or just through the outlet purely because of the high commissions that a Swiggy or Zomato would charge. So I think this is what they've avoided essentially.
But also what they've done is they've sort of see, because the revenue is capped at advertising and fulfillment, they've obviously missed out on the entire commission revenue, which is great, right?
Correct.
Which is amazing, a source for revenue,
Right.
which Flipkart and Amazon do have. So in order to monetize or at least find other sources of monetization, over the years they've experimented with a few things.
Okay.
And one of their initiatives was this one product called Meesho Mall.
Okay.
So Meesho Mall is supposed to be where brands come in. And these are
Okay.
not unbranded products, and where Meesho will charge a commission for listing their products out. However, the pickup of that is pretty slow because there are several factors which sort of come into play. Effectively, till date, Meesho has not been built for brands.
Right.
It has been built for smaller individuals or enterprises.
Correct.
So they lack a lot of, for example, they lack a healthy return on ads. They lack reliable insights and analysis on
Right.
their platform. They don't have enough checks on false products,
Right.
which is a very strong commitment by Flipkart and Amazon to
Correct.
not have on their
Right.
entire platform. So because of these things, what is happening is, although they're trying to get into that space, that is becoming a little bit of a slow pickup.
Right.
Because the DNA itself is different. So you're right about saying that it supports that larger ecosystem, but it's not really meant for brands yet.
Correct.
They may be moving in that direction and trying it out, but we don't know how it'll work out.
I think it also depends on how, with the development or increase in income in the sectors that they are targeting, they will. So when smaller towns, people living in smaller towns start earning more, naturally they would become more aspirational and they would want brands. And I think Meesho would have to sort of ride that wave as and when it comes along.
Possibly, or the other way, because if I look at this movement from unbranded to branded, there is a similar movement happening or an attempt happening from Flipkart and Amazon's side to go into unbranded.
Go backwards.
So Flipkart's launched a product there. Amazon has launched something called Bazaar, which is Flipkart's is Shopsy. So these guys have launched platforms on the other hand.
Correct.
Going into or encroaching into Meesho's space.
Right.
So I think migration is happening on both sides because both markets are fast growing and attractive, right?
This episode of Taking Stock is brought to you by Paterson. But you were also mentioning earlier, no, that they've got a massive sort of differentiator built around their logistics as well.
Yeah, so actually it wasn't so much of a differentiator. So what happens is, to just take a step back, in the case of a lower AOV product, efficient delivery becomes very important because it doesn't make sense when you're delivering a dress which is worth $250 and the delivery costs about 50 or 60 rupees.
Correct.
The economics just crash out.
Absolutely makes sense.
It always makes sense or is easier when it comes to higher average order values and not so much for smaller ones. So for the longest time, so right now what the scene is that Flipkart and Amazon have their own captive delivery arms.
Correct.
Usually what used to happen is there are third-party logistics players like a delivery, like an e-com express that we've covered earlier. Now these will make anywhere between 20 and 30% contribution margins. Now, why should a brand where the delivery cost is also making a difference in terms of a buyer's decision making, be in a position to give that margin? So it makes sense that over time, as you learn and figure things out, you sort of build your own delivery as well.
Correct.
So Flipkart has got something known as e-cart. Amazon does it through Amazon Transport Services.
Right.
And for both of these combined, about 80 to 90% of the deliveries are made using captive sources.
Okay. So what does captive sources mean? You're in-house. Yeah, okay. Fair enough.
And 10 to 20% goes to third-party or 3PL players like e-com express or delivery.
Right.
For Meesho, this was not really the case. So e-com express was a majority of their delivery. However, what they've done is they've now built a whole different model.
Okay.
So they've built a entity called Valmo.
Okay.
So Valmo, what it essentially does is that it fulfills delivery, but using third party, but not integrated players like a delivery or e-com express. So for example, an e-com express or delivery or a third party logistics player will do everything from picking up the item at the seller's end to putting it in a warehouse, sorting center, another warehouse, delivery.
Everything end to end essentially.
End to end.
Right.
Valmo basically breaks the entire chain down.
Okay.
and offers fulfillment to local partners at different levels.
Understood.
So it sort of plays a bidding game. For example, which partner is available right now? If it's $60, it'll sort of say, oh, you're doing it for 30, you're doing it for 40, it goes to you.
Understood. So one second. So Valmo is owned by Meesho?
Yeah.
Okay. So they've developed this to eventually solve that whole problem of a 50 rupee delivery fees for a 200 rupee product, right? That's the whole intent. It's fairly, it's not fully imbibed in the company right now. About half or a little more of their deliveries would be managed by Valmo right now. Understood.
And that has already affected Ecom Express and put their valuations down, and then delivery acquired and all that jazz.
Correct.
But Valmo has the it's picking up fast, and it has the potential to sort of cover a lot more ground. So what it essentially will do is, for example, the first mile pickup itself. First mile is being from the seller is picking up the object. That will be given to a different partner. Then sorting center will be different. It may be a local,
go to different warehouse,
local courier office. It may go to, from there it may go to somewhere else. So what they're targeting essentially more than also, so they're not saying we'll be the fastest to deliver.
Correct.
Because this may take a longer time. Right. But
it'll reach you at low cost essentially.
It'll reach you at low cost. It'll reach you in a predictable manner. Because if you are not available, it'll go to somewhere else. It'll optimize the route. It'll go in a much more efficient manner. They're not targeting speed, may be an outcome, but that is not the intent.
But I also understand that when we're talking about the audience that they're targeting, which we've obviously established that they're extremely price sensitive. Speed, if it takes a little bit of a hit while saving costs, it might actually work. Right. And that's what's exactly happening, right?
Yeah. And in any case, I think, in a lot of these pin codes which are in tier 2, tier 3 or beyond, speed is not the highest.
Correct.
Today, what happens
Nothing works at speed.
Nothing works at speed. Like a lot of times earlier, I remember buying, the other day I ordered a book from Amazon. It's reached me in 30 minutes.
Correct.
A book had never reached me in 30 minutes before. It had always been a day at least.
Right.
And now, living in Bangalore, living where we live, it's available. But that's not the case if I order in Vadodara, for example, which is not really tier 2, tier 3.
You won't get your food in 30 minutes also. So forget a book.
Food you get.
Because the restaurant's next door.
Yeah. Actually, food you get faster because there's no traffic. And
there's no traffic. This episode of Taking Stock is brought to you by Paterson. So what we're essentially establishing is that Meesho's built these differentiators, right? Yeah. Where one is your Valmo and the whole logistics bit. Second is, who they are targeting. They've really nailed it down in terms of what they're selling and who they're selling to. And last and most importantly, the zero commission bit, which I still don't think is sustainable.
Why?
It makes no sense. I don't think they can make their entire money purely through advertising.
So over time, that should change, is what you're saying.
I feel it will have to.
Handling charge.
Yeah, I mean, you mask it however, all those dark patterns are a thing now. But yeah, anyway, and that, which is what brings me to my next point, right? That when I was going through the sort of article over here, what I also understand is that Meesho is one of the fastest growing startups in India, but is not doing well on operating profits, right? The EBITDA is still negative.
Yeah.
So how is it one of the best companies?
No, I mean, ask Forbes. Not me. So see, in FI, they're at scale now, right? So in FY 25, for example, they did upwards of 9,000 crores in revenue. So they are huge. And they're growing at 28-30% every year, which is also the fastest growing. Because then Amazon would be growing at somewhere around, Amazon and Flipkart will be growing in the high teens or say 20-21% sort of growth rates. And these guys are clearly higher. However, you're right, the EBITDA margin is at a minus 6.2% in FY25. You're not getting any better. So in the sense, a lot of companies, you see that curve happening and then
they're going to break even in the near future.
Yeah, so Meesho's not profitable yet. It's doing, although it's achieved scale, it's got like a revenue that is upward of 9,000 crores in FY25.
Because they're not charging commissions.
And they're growing north of 20. They're actually growing at like 28-ish%, which is much higher compared to both your Flipkart and Amazon. But Amazon recently turned positive. and this guy is still at like a -6% EBITDA margin. So you're right. One is that. Second is also.
But you mentioned that they're not even going towards an upward trend.
I mean, FY24 was -6.5. FY25 will be -6.2. FY26 maybe they'll do a -4. So slowly inching up there, but not really in a meaningful manner where I can confidently say that within the next 2 years.
Understood.
So that's a bit of an issue. The thing is, see, there is obviously, I mean, there are several costs which are hitting them in a very negative manner. One is that there is an advertising cost which is pretty heavy.
Right.
Logistics costs are still heavy, because they don't have a captive like the others, right?
Right.
They're also sort of pioneering the model and optimizing it as we speak. So these costs may come down in the future.
Right.
But at this point in time, they're still pretty heavy in terms of the overall cost structure. The other 2-3 things are that when the average order value itself is low, they fundamentally can't make higher margins.
Right.
So that is a problem which is more fundamental, and that's why I'm not very confident of sort of putting a year to
timeline to it. They are going to become positive.
So that is one issue. The other issue is that with this market, again, these are fundamental issues. The cash on delivery is very high. Correct. So it's about 75 to 80% for Meesho, whereas it will be much lower for a prepaid orders will be much lower for Amazon and Flipkart.
Prepaid will be higher.
Higher for Amazon and Flipkart, right. Not for Meesho.
Correct.
In this case, what happens is sometimes, so one is the entire ecosystem becomes inefficient because somebody's collecting cash. That cash has to go through various channels and reach Meesho in the first place. The other thing is there is a lot of failed deliveries and returns.
Because it's cash on delivery, people change their mind, etc., etc.
Yeah, and when you're delivering to these places, the cost of delivery is also higher compared to easier locations which Flipkart and Amazon are serving.
Correct.
So that again becomes a fundamental issue which is not solvable very fast.
Correct.
Because critical mass has to be achieved in multiple pin codes for you to be profitable at a unit level at multiple pin codes.
Right.
So that becomes difficult. So that inefficiency sort of results in a place where Meesho is not doing too well on profitability. Meesho is also trying to curb it down at some levels. So they offer discounts to people if they select a no return option, for example.
Understood.
Or if they say that if you're going to prepay the entire...
You get it slightly cheaper or whatever.
But in that case, they're trying to change behavior, but that is not really fundamentally changing the economics of their
because they're going to lose more money or spend more money just to...
So the amount of risk there was by the inefficiency is the amount of discount they're giving to avoid it. So it's kind of getting pittus.
Right. But I think behavior will change with time.
Yeah.
Right. But that's the thing, right? It's a function of time, and it's also something that Meesho I don't think can control. I don't think one company can control the behavior of 30-40% of the country's population. Right.
So, I mean, these things are why I think while there is immense growth in the company, like if you look at, I think there was one report by UBS which went like extremely, it became popular and affected the stock price massively as well. Basically, they came out of the buy report citing the asset light model as a positive, which is the negative working capital is a positive, which again is. However, what it also does is, say for example, it says that from FY25 to 30, they will be able to clock a 30% CAGR in the net merchandise value, which is very doable because the number of transacting users are increasing in the market, as well as the order frequency is much higher.
Understood.
So on average, which is again a great fact because people are sort of ordering in smaller buckets, right?
Correct.
So the order frequency right now is at about 9 times a year. They're expecting it to go to about 14 times.
This is per customer.
Yeah.
Okay.
Which is also great. But I think the problem is where the average order value, which is 274 right now, is actually going downward. So that's where it becomes problematic because that will again determine a lot of the financial metrics that we're talking negatively about. So in short, I think the remarkable bit is that although it generated a free cash flow, which is positive in FY25, the margins are still sort of negative.
Right.
And although they are the fastest growing, they don't have a direct comparable in the listed space, even when it comes to the internet players. but still negative margins.
But if you had to, if you had to make a calculated guess, right, that by which year or in how many years do you see Meesho being a bit positive? And obviously, this guess is based on today, the day of recording. Things will obviously change, right? How many years would you say it would take?
I really wouldn't put a number to it. I mean, because they're already free cash flow positive, so that is a great sort of positive point. And a lot of analysts are putting that number to 1 year, where they'll probably EBITDA break even
in the next 1 year.
In the next 1 year.
Okay.
But at this point in time, looking at how the trends are sort of moving, I would not and I don't know if I'm supposed to, but anyway, I wouldn't place it in the next 2 years.
It's a bit too late now.
Yeah, I mean, you asked the question already. Yes, I'm forced to answer.
This episode of Taking Stock is brought to you by Paterson. So my next question, right, again, which is something I always find confusing, is how do you value a company? Because at the end of the day, the conclusion of every podcast is how do you look at the valuation of the company or the stock we're talking about, right? But how do you value a company that isn't profitable?
Yeah, on sales.
and a company that isn't profitable, even profitability is not even on the horizon in the next few years, right? So how do you value something like that?
No, and even if it is, say, for example, I'm wrong in terms of profitability, they achieve profitability by FY27, for example. Even then, they're not going to achieve normalized profitability, and hence pegging valuations on a lower profitability or number which is not sustainably low doesn't make sense.
Okay.
So at the end of it, what does make sense is, probably from my angle at this point in time, is to probably just look at the EV by revenue of the company.
Okay.
Which is the enterprise value divided by the revenue.
Right.
If I look at that, Meesho sort of trades at a steep discount compared to its peers. And there is no direct peer, but still. So, for example, Meesho would be trading at about 2.5 times EV to revenue.
Okay.
Whereas Swiggy is at 5 times, urban companies at 7.5, India Mart is at 7.
But are these 5. Direct? You can't really.
They're not.
That's what, right?
That's why I don't want to even get there in terms of comparison. But what I would probably look at is that whenever a company, even if it's not achieved sustainable or steady state profitability, as soon as it starts showing signs of reaching that profitability, a re-rating happens.
Correct.
So the profitability the valuation has the potential of going from a 2.5 times to a 4 times or 5 times.
Right.
Provided there is visibility of profitability coming on a sustained level.
Right. Understood.
So I think hence what the thesis depends on is, and what the most important metric becomes hence is, when they will achieve profitability and how much.
Right. So that's what you're sort of, if you're tracking this company or even thinking of investing, this is what you sort of keep an eye on.
This is what I would keep an eye on. And in fact, I would go to the level of sort of saying that still there are a few things of where you would say that, okay, this company deserves a premium to whatever non-comparable peers there are, and there is a set of reasons why there should be a discount also. So I think for me, the largest metric in terms of figuring out whether even to buy it or not from a financial or a business standpoint before even coming to valuations is sort of keeping track of profitability.
Makes sense.
That's why I wouldn't pay too much attention to the valuation right now, because do I really like the business model, and is it really a business model that can generate profits on a sustained basis or not? I want to confirm that before even moving towards saying that is this the right price to pay or not.
Correct. Cool. Sounds good. I think that's about it. Keep a track of profit. Keep a track. You've thrown me. Keep a track on the profitability of the company. I think that's the metric that everybody should be tracking. And if it moves in the right direction, there is a re-rating possibility. Right? That's all for today. Thank you so much for listening. Please like, share, subscribe, let everybody know about this podcast, and let us know in the comments as usual which companies you'd like us to cover. A lot of you guys have put down companies, and we have added those to the pipeline, so they will be coming up soon. Thank you so much.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.